Legendary investor Howard Marks recently said, "You make the most money by investing in things that are out of favor, where consensus is negative, but the fundamentals are intact." That mindset has never been more relevant than right now. Beneath the surface of this seemingly strong market, a powerful shift is taking place. The S&P 500 may look healthy on the outside, but leadership is changing fast, and smart investors are quietly making their move. This market isn't crashing, it's rotating, and those ahead of the herd are repositioning before the crowd catches on. After a months-long melt-up fueled by the Magnificent Seven, cracks are beginning to form. Tech earnings are decelerating, from 35% growth a year ago to barely 10% now, while overhyped names like Kohl's are spiking in meme-fueled rallies that scream speculation. At the same time, industrial giants like General Motors are absorbing billion-dollar hits from tariffs, warning of deeper macro pressures ahead. But here's the twist. While tech stalls and tariffs bite, the rest of the S&P 500 is finally waking up. Earnings for value and dividend stocks are accelerating, and their valuations remain attractive. Inflation is still sticky, interest rates are still elevated, and trade tensions are rising. In this kind of environment, capital preservation matters, and so does disciplined positioning. In this video, we're going to highlight 3 stocks that align perfectly with this rotation thesis: a bruised industrial on the cusp of a turnaround, a defensive dividend fortress, and a financial name built for uncertain times. If you're looking to position ahead of the curve, now's the time. Let's get into it. First on the list is Verizon Communications Inc., ticker symbol VZ, a stock that perfectly fits the rotation thesis we're talking about. In a market where tech valuations are sky high and speculation is rampant, Verizon stands out as a rare combination of stability, value, and income. While the broader S&P 500 trades around 30 times earnings, Verizon sits at a single-digit PE, all while throwing off massive free cash flow and offering a dividend yield above 6%. That kind of income is hard to ignore, especially in today's uncertain environment. Verizon's business model is simple but powerful. It runs one of the largest wireless networks in the US, with more than 5 million 5G home internet customers and hundreds of thousands of net subscriber additions in the first half of 2025 alone. It generated nearly $9 billion in free cash flow over just 6 months, up 4% year over year, which comfortably covers its dividend and fuels future investments. That includes major ongoing upgrades to its 5G C-band network and continued expansion of its fiber infrastructure, both of which are key growth drivers in the years ahead. Yes, Verizon operates in a competitive space alongside AT&T and T-Mobile, but it has proven it can hold its ground and return to growth. After years of heavy capital spending, Verizon's network is now on par with its rivals, and it's starting to benefit from lower operating costs and improved margins. Its EBITDA margin rose to over 37% in the last quarter, and the company has guided for continued earnings and cash flow growth in the second half of 2025. In a market that feels overextended, Verizon offers something rare: consistency, scale, and cash flow. For investors looking to rotate into value and protect against volatility, this telecom giant offers not only a high dividend but a path toward long-term upside. It's not flashy, but it's powerful. Next up is Pfizer Inc., ticker symbol PFE, a company that most investors still associate with the COVID era, but the truth is, Pfizer is undergoing one of the most dramatic turnarounds in the entire healthcare sector. Far from being a fading vaccine giant, Pfizer is reinventing itself as an oncology powerhouse, aggressively investing in the most exciting frontier of cancer treatment: antibody-drug conjugates, or ADCs. With its $43 billion acquisition of Seagen, Pfizer now controls the deepest pipeline in this revolutionary space, what many analysts call the smart bomb approach to cancer therapy. But the story isn't just about acquisitions, it's about a structural transformation from top to bottom. In the first half of 2025, Pfizer executed major cost realignment, boosting gross margins to 81% and reducing operating expenses by 12%. This isn't cosmetic, it's foundational. AI is being deployed across clinical trials, drug modeling, and even the supply chain, streamlining development and accelerating innovation. As a result, Pfizer has now delivered 12 consecutive earnings beats. That's not the profile of a company in decline. At the same time, management is steering aggressively into high-margin growth areas while defending its dividend, currently yielding over 7%. That dividend is backed by strong free cash flow and a clear commitment to maintain and grow it. While the market fixates on a looming patent cliff, Pfizer is already offsetting it. Blockbuster oncology assets like Padcev and Elrexfio are seeing rapid global adoption, while promising late-stage candidates in lung and bladder cancer could reshape standard of care by 2026 and beyond. What makes Pfizer especially compelling right now is the market's blind spot. While Wall Street focuses on past revenue erosion, it's ignoring the platform Pfizer is building for the future, a leaner, AI-driven, oncology-focused giant trading at a major discount. If the rotation toward value and yield continues, Pfizer is perfectly positioned. It's not just a dividend stock, it's a growth engine in disguise. And finally, let's talk about General Motors Company, ticker symbol GM, a stock that's been punished by headlines but tells a completely different story beneath the surface. GM crushed expectations in the second quarter, posting $47.1 billion in revenue and $2.53 in adjusted EPS, yet the stock dropped 8% on fears about tariffs. But here's the thing, that drop wasn't about deteriorating fundamentals, it was about investor overreaction. GM confirmed its full-year outlook, including at least $7.5 billion in free cash flow and $10 billion in adjusted EBIT, even factoring in up to $5 billion in tariff-related headwinds. That kind of resilience is rare, especially in a market as uncertain as this. What makes GM compelling right now isn't just the bounce-back potential from a sell-off, it's the company's strong execution in both its legacy business and its growing EV portfolio. US sales rose 7% in Q2, and electric vehicle sales surged 111% year-over-year with over 46,000 EVs sold. This isn't hype, it's traction. GM is delivering on its promise to become a serious EV player while maintaining leadership in trucks and SUVs. And while tariffs may be creating noise in the short term, the long game is starting to look much clearer. A new US-Japan trade framework just dropped, aimed at reducing friction and boosting auto sector cooperation. Japan is committing $550 billion in US investments and opening its markets to American automakers, a huge step forward that could ease trade tensions and restore investor confidence in GM's global outlook. With shares trading at just 5 times forward earnings versus Ford's 8 times, and with Ford suspending FCF guidance, GM stands out as the better-positioned auto stock. It's profitable, it's generating real cash, and it hasn't blinked in the face of tariff turbulence. For investors rotating into value with strong operational visibility, GM offers an attractive setup. Ignore the tariff noise. The fundamentals are intact, the pipeline is active, and the upside is still very real. In a market clouded by speculation and uncertainty, it's clear that smart investors are starting to rotate away from hype and into substance. Verizon, Pfizer, and General Motors aren't just undervalued, they're transforming, executing, and thriving in sectors that offer real-world resilience and long-term upside. Whether it's Verizon's steady cash flows and yield, Pfizer's oncology breakthrough, or GM's EV momentum despite tariff headwinds, these companies are quietly building value while the spotlight remains elsewhere. This isn't about chasing the next meme stock, it's about positioning ahead of the curve. If the market truly is rotating, these are the names leading the next chapter. Thanks for watching. If you found this insight valuable, don't forget to like, subscribe, and share your thoughts below. Which of these value plays do you believe has the strongest upside? Let us know. We're building smarter portfolios together.